Hi, everyone, and welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Let's get started.
Tonight, Iranian missiles hit the main energy hub of that nation. This is the world's largest liquefied natural gas export facility, and there is significant damage there.
Today, the FOMC decided to leave our policy rate unchanged.
It took 6 years to build $4 billion. It is big, it is grand. I have not seen any cockroaches.
All right. Questions?
It's been a couple weeks since we chatted, probably because spring break's going on here in Texas, as most of you probably know, especially if you have kids in school. Last week was spring break for the majority of our state. This week, I think we got some schools that are still straggling back in. So had a nice trip out to Colorado, really enjoyed it, but did not let the markets leave my sight. I was the guy down at the bottom of the hotel at 6 or 7 a.m. every morning, just keeping up, catching up with news stories, catching up with what markets are doing, really mainly just to get there because they cut off the free coffee at 8 o'clock. One of the nicest hotels in Telluride does not serve free coffee after 8 a.m., so just make a note of that. However, this week, still got the rodeo going on, really exciting stuff. But a lot of things have happened over the last couple weeks, and so I thought it would be helpful just to kind of get back and get connected. Obviously, geopolitical risk has continued to tick higher and higher. We have a conflict or war in Iran. Hard to really understand exactly what's going on the ground because there's not really much news coming directly out of Iran. So we just kind of have to piece things together and see what's happening, in the data side of things with commodity markets. Obviously, just recently we had some new attacks on some LNG facilities in Qatar, which definitely is going to send and is sending the price of natural gas significantly higher today, along with oil. So additional production capacity being blocked into that country for probably a little bit longer than everybody expected. That has nothing to do with the Strait and the shipping, Strait of Hormuz or the shipping side of things. That's just actually being able to put LNG on ships. And so that's definitely got commodity markets worried. You can see, natural resource commodities like oil and gas trading higher, but you can also see, other kind of commodities, industrial commodities trading lower. And I think that kind of makes sense because when you have less energy supply, you're less able to turn those industrial commodities into products, or it's more costly to do so. We've also had a Fed rate announcement last night or yesterday afternoon. We're going to talk about that and what that might have, or what impact those two things might have on inflation over the rest of the year. And then we're going to spend some time talking about private credit. Private credit wars, actually, I think is what we're starting to see form up in the market. You've got a lot of suppliers of private credit, a lot of really well-known household brand names, and they're starting to go at each other. And so we'll see, we'll talk about what we're observing and, what's the real impact that you might actually see in your accounts if you've allocated to private credit. And then we'll touch on some other things. We always like to leave you guys with a note on diversification and, not get too focused on any individual item. Okay, so what's going on in Iran? And I think we just talked about this when Andre Costas, one of our portfolio managers, head of investment relations, was on a couple weeks ago. Obviously, that war is still ongoing. I think we're in week 3. Week 3 means that there's been steady attacks from the U.S., from Israel. What we saw over the last few days is that other NATO nations have decided not to escalate or not to participate in this war. So it's going to seems like at least for this foreseeable future, the U.S. and Israel against Iran. Iran continues to lash out at its neighbors. So we're seeing most recently attacks on Qatar LNG facilities. From a damage perspective, it's unclear what damage was actually done physically. However, I think one of the things that we need to note is that those facilities largely, if not completely, had already been shut down because of the risk to those facilities, right? So that supply was already locked in. And if anybody that's worked in the oil industry knows that there's not just a big light switch that you turn these facilities off and on. These types of facilities take days, weeks, and sometimes even up to a month to turn back on once they've been shut down. There's a number of different things that have to happen, and obviously it has to be done in a safe way. However, that is under normal circumstances. When there's been damage to a facility, that time is going to be stretched out even longer. And so Where we're at today is that production, that liquefied natural gas is likely going to be shut in. And you can see that in the commodities markets as well, in the futures markets. Obviously, spot prices are spiking up. That's where you're seeing the, plus $100 oil. But if you look out a few months, kind of middle of the summer, even towards the later end of the later half of this year, you still see elevated prices, probably to the tune of $10 to $15 versus where they were before this conflict started. So that is what the market there is telling us, that even if this conflict ended today or within the next week or so, you would still have a recovery process, right? Inventories have been drawn down, reserves have been drawn down, and it's going to take a while for those commodity markets to come back to equilibrium. So what does that mean in terms of the impact to things in our portfolio? Again, our clients, they typically don't have a lot of commodity exposure directly, but they do own securities that either use commodities or produce commodities, and also countries that have some more exposure to commodity shortages. So what we've seen in our portfolios, really emerging markets, which were doing quite well up until this conflict, are taking probably the biggest hit, and likely I guess what we're seeing is the Asia emerging markets, and really just Asia countries in general, are taking the biggest hits when it comes to these commodity shortages. Again, commodities coming through the Strait of Hormuz are the main energy supplier for countries like Japan, countries like China, and the emerging market countries as well. And India also a big user of commodities that come through, not necessarily buying all of its oil from Iran, although I believe it does secure some of its supply from Iran, but really, Qatar, Saudi Arabia, all those countries, that capacity is locked in. And so India has taken quite a hit. They also have some challenges. A lot of Indian citizens will actually work in some of those Middle East countries and send a lot of capital back to their families. And that, those jobs likely will be disrupted, at least temporarily, if oil production is shut down, and then even consumption may come down in some of those countries. That's definitely not good for India. For the individuals that go to those countries to work and have jobs and send money back home. So India is definitely a little bit more in the crosshairs than some of the other emerging market countries. However, don't want to spend too much time on that. Obviously, South Korea taking a big hit as well. South Korea, I'd say, from an energy perspective, obviously is almost completely dependent on foreign energy, but also has some exposure into the SaaS apocalypse side of things and where they sit in the AI story. So kind of getting hit from both sides as well. We also had a Fed rate pause. So Fed met Wednesday afternoon, decided to keep rates where they were, 3.5 to 3.75, I think is where we're at. And so kept rates where they were. No surprise to the markets. I think what you're starting to see, though, is you're starting to see the Fed, participants coalesce around that one cut this year expectation. Why is that the case? Well, number one, we've got a new Fed chair coming in, so I don't think anybody's trying to make any big bets before that change takes place. But obviously, if you go back to the dual mandate of the Fed, it's inflation and then it's employment. Obviously, the employment side of things is continuing to, deteriorate is probably too strong of a word, but continuing to be a little bit less positive, meaning that job creation has slowed a little bit. And we've also seen, some layoffs in pockets, and we've obviously got, potentially more layoffs that are either AI related or just economically related for efficiency gains. So the labor market is softening, and we're also seeing hourly earnings come down, kind of to the tune of being right in line, hourly earnings growth being right in line with inflation. So the labor market is softening. So on one hand, the Fed has, some ammunition to say, okay, well, we see this softening, we can cut rates into that. However, on the inflation side of things, given the recent spike in commodity prices, that has follow-on effects to inflation. Obviously, commodities is not part of core inflation, but commodities do go into a number of products that are part of that core inflation basket. And I think there's some apprehension from the Fed that those commodity prices will have some follow-on effects that are additive to what we've seen from in the way of tariffs that have come over the last 2025 and still have impacts in 2026. So you got commodity impacts plus tariff impacts. So I think that's got the Fed thinking that maybe inflation has the potential to resurge. Although we do try to keep a wide aperture and look at all the influences on inflation. So one of the, I would say, dampening aspects that we potentially could see on inflation is housing and shelter costs. Obviously, we know that the housing market as it relates to single family homes still substantially undersupplied. However, on the multifamily side, that's going to be apartments. We do know that there is a significant supply build, and that supply build has kind of peaked, I think, in 2025. So that has the potential to allow for some either stabilization in rents or maybe even some softening in rents as that supply is absorbed by the market. And so that has a potential of kind of softening that shelter cost. When we work with our private market data suppliers, they can look at their own properties. They have also confirmed that they are seeing some softening in rents in pockets. Obviously real estate's always local. They've seen some softening in rents or just smaller increases that they're able to achieve. So that's typically a lagged effect on CPI. CPI does not capture rents directly. It captures more of a survey-based metric. And so it takes a little bit of time for that data to come through. So you do have some balancing effects there. Consumption, typically volatility in the markets, negative wealth effects that we've seen so far this year with the markets, kind of being a little bit negative. That does have the potential to negatively impact consumption. And so that would be an additional headwind to inflation. But obviously those are things that we're still waiting to play out in the data. And so that's definitely something that we're keeping a close eye on. But I think the Fed is also kind of saying, okay, we're going to take a wait and see, a data dependent approach here. So let's switch gears. So if you talk to somebody that's trying to market private assets, I think the recent conflict in Iran, the war in Iran, was a welcome little change in news flow, because the news flow has been overwhelmingly negative for private markets and really focused on one particular asset class, which is private credit. And I think it's even worth probably mentioning that you're starting to see, I would call it private credit wars, where over the past couple of years, call it 2022 to 2025. I think most suppliers of private credit, most sponsors of private credit funds were just happy to be in the market. Everybody was seeing inflows. Really hard to differentiate, a top tier fund from a, kind of less so fund or a mid tier fund. However, typically what you hear is when the tide goes out, you find out who's swimming naked. And that's likely going to be the case with private credit over the next year or maybe even 2 years. So what are we seeing in the private credit market? So number one, private credit, they do tend to lend to companies that are SaaS-oriented companies. That was something that attracted a lot of attention to the asset class over the last few years. However, those companies have come under pressure. Their earnings as SaaS companies are obviously have the potential to be disrupted with AI technology. However, that's still uncertain. I think there's apprehension about that, but there's not agreement about that particular angle today. And some companies likely will be disrupted. Some companies will probably be able to take advantage of AI and actually strengthen their software models. And so that's kind of TBD. But I think what that trend introduces into the market is uncertainty. And you're seeing that borne out in equity prices. You're also seeing that borne out in the prices of loans that have been made to those portfolios. Now, I think one thing is worthwhile mentioning. When we look at our private credit portfolios, and we've invested in a number of different sponsors, you do see some of those loans held at discounts to par, right? So some of those loans are priced at a level that implies that there's going to be some losses. I think just pointing out something, though, for a private credit sponsor to lose money on a loan that they've made that's typically senior or at the very top of the capital stack, for them to lose money on that loan, the equity has to be completely wiped out. And what we've seen in public markets and other areas where we can observe the value of these companies, that the equity has not been wiped out yet. So there's some discounts. The companies are trading at discounts, but they're not trading at zero. And so just kind of keep that fact in mind. For a loan to lose money in the private market space, typically the equity has to be fully wiped out. The reason I think this is worth mentioning is because when most of these companies are lent to, they're being lent to at kind of a 35 to 40% loan to value ratio, meaning that there's a good chunk of equity that has to disappear before that loan takes a hit. Now, what we're starting to see, a couple of the news stories that have come out, the most recent one I think was J.P. Morgan and Jamie Dimon saying that they're gonna back away from lending to private credit sponsors. They're gonna back away, or they may force repricing of portfolios of private loans that they have lent to as a lender to a fund of private loans, which is an interesting development. One of the travels that I did, so after spring break, I was able to go to a conference in New York as a private asset conference. I'm not going to name the name of the sponsor, but in travels to that conference, I did walk by the new JP Morgan Tower, JP Morgan building. It probably has a better name than that. It is an architectural marvel. I would highly recommend anybody visiting, the kind of the Midtown area in New York. If you're able to just do a quick walk by that building, it is astounding. However, the day that I was walking by that building, it was fairly cloudy, and so standing at the foot of that building, you would look up, you could not see the top, and so it clearly reminded me of sort of like a villain's tower, right? And out of every comic book, out of every superhero movie, you can see the tower that the villain, lives in, and he's up the top floor controlling the world or controlling his evil empire. But there's typically clouds surrounding that building. So that's the impression that I got, which was, kind of very timely because it was about the same time that news was coming out that JP Morgan was going to be backing away or forcing higher discounts to some of the portfolios that they've lent to. Now, one of the things I think that is interesting is, JP Morgan has obviously been in the press several times over the last few months. I wouldn't say bashing private credit, but definitely using the term cockroaches. And so, there's definitely concerns, and I think it's worth taking their opinions with a little bit of grain of salt because they're a competitor in that space, but also, the comments aren't coming without merit, right? There's definitely some loans that are challenged in those portfolios. So what I thought was helpful is just to think through, what is a really, kind of a bear case scenario to think of for a private credit portfolio, and then what could that do for returns? So most investors that have owned private credit over the last couple of years have experienced, pretty good results, very low volatility, returns, in the 9, 10, 11, 12% range, going back 2021, 2022, 3, 4, 5. So fairly healthy returns with pretty minimal risk. And that's typically, the result of an expanding economy. Typically firms are growing their earnings, they're able to pay their debts. And so that's, everything is great, right? So now 2025 or the back half of 25 and 2026, we're going through a little bit of a different environment. We're starting to see some of those companies that we, may have had really positive growth expectations. Some of those growth expectations are coming down or turning negative. And so you're going to start to see some corrections in these portfolios. Some of these portfolios, or I would say most of them, have already been marked down, a handful of percentages, call it 3 to 5% at the end of 2025, December 2025. These portfolios typically don't price every day, but they price, once a month or once a quarter. And so they've already been marked down a few percent to reflect some of those discounts in the market. So if you think about what's a really bad scenario, if we go back to some of the historical loss scenarios, GFC or COVID, when there was stress in the markets, a high level of defaults is probably mid to low double digits, right? So if 10% of your portfolio defaults or 10% of the companies that you lent to default, that's a pretty significant or pretty large number, right? So if you take that number, 10 to 15%, you said, okay, well, when a company defaults on their loan, it doesn't mean that you lose everything, right? As the debt holder, you're entitled to the asset of that company. So the equity holders obviously do get wiped out, but the debt holders, they get to recover something. So a reasonably conservative recovery rate is probably in the range of 2/3, right? So you got 10 to 15% of a portfolio, in some type of default. And this is, again, bear case scenario in a real substantial economic contraction. So you got 10 to 15% in default, recovery of 2/3 of your assets, so you're losing, maybe 3 to 5% of capital, right? And that's loans that have probably been paying, for the most part, paying over the last couple of years. Some of that discount is already priced in. Like I said, most of these portfolios are discounted, at the NAV level about 3 to 5%. So some of that's already been absorbed. And then if you spread that loss of, additional 3 to 5% over a couple years, you're looking at maybe a 2% headwind in values this year, maybe another 2% headwind in values next year. Those portfolios, though, the companies that are not defaulted are obviously still earning a positive return, typically in the range of, 8 to 10%. And so you take that 8% on the low end, you subtract out your 2% per year, you still tend to be in a positive earning scenario. But your positive earnings coming off the back of some really good years probably sound a little bit more like cash level returns. So maybe you got some soft years. So if your experience as the investor in these funds over the past 3 or 4 years has been pretty good, low to mid double-digit returns, maybe some high single-digit returns, but with really low volatility. You may have a couple of years that, are kind of more mid single-digit returns, still with modest volatility, but a little bit higher volatility. And that's, I think a fairly conservative expectation of the experience that might be going in with these funds, right? So just kind of keep that in mind as we go through, like, the news stories that are trying to, paint this asset class as, significantly under pressure. There's some truth to those stories, but the magnitude of pressure, the amount of, potential loss is still fairly, at least in our view, going to be fairly well contained and may not even result in a negative return year for these portfolios, given that they are well diversified across hundreds of loans, different sectors across the economy. They're not 100%, software loans in the portfolio. So they do have, good diversification built in. So with that in mind, obviously, again, as the tide goes out, we're going to see the funds that have structured themselves with the best protections, the best underwriting, the best operations. We're going to see those funds hopefully rise to the top. And I expect that, and hope that the funds that we've selected for our clients are in that basket. So far, everything that we see confirms that expectation. But obviously, there's more time will tell the full story. I think it's always good to look at, okay, well, what's the impact of that in the total portfolio context? And do we still have diversified portfolios? So obviously, when we build private portfolios for our clients, they're a diversification tool that we use to complement the public assets, to complement the public, equities and fixed income. But we typically don't see an all your eggs in one basket approach when it even comes to privates, right? So we have private credit is a stable, kind of foundational component of a lot of our private portfolios, good low risk returns, attractive, premiums over public market counterparts. But then we also look at other asset classes, real estate, infrastructure, private equity, all those asset classes, they go through their own times of challenge and they go through their own kind of times of boom or better returns. And what we saw, I think private real estate's a good example. Private real estate went through some weak times, not surprisingly, when you go from 0 interest rates to 5% interest rates on cash, right? That pressures the return of real estate because real estate, projects and real estate properties, they do tend to borrow. And so when rates increase, your cash flows decrease, there's less left over for equity holders, and it also makes it more difficult to pay your debts back in full. And so real estate went through some challenges over the last couple of years. I would say that the headwinds to real estate are abating. Obviously the headwinds to interest rates are still a little bit more elevated than we'd like them, but they've come down a decent amount, and they are also looking to have some stability, at least in the near term. And so for real estate, that's at least not a headwind, right? It could be a potential tailwind. I think it's probably a little bit more neutral now, but the headwind has been removed. And the other headwind to real estate, again, going back to that 0 interest rate environment, a lot of projects got approved. It was very easy to pencil in projects that looked profitable because you were working with very low cost of capital. That resulted in a lot of inventory being delivered to the market, especially in the multifamily housing space, but even in some cases in the industrial space, resulted in a lot of inventory being delivered. Obviously, rates increase. Those projects don't pencil in. The development of that new inventory declined substantially. And so 2026, we're again seeing that headwind of too much inventory being delivered with not enough people to consume it. That headwind is also looking to be removed, right? So whether it's, whether we call the environment for real estate significant tailwinds or just the removal of headwinds, I think the ice is thawing for real estate. So it's definitely looking better, going forward than it does look than it does going backward. Infrastructure, another asset class that we've allocated to for a number of years, has some merits in terms of historical returns, very attractive historical returns, but also has some merits in terms of inflation protection, stability of cash flow, certainty of contracts. That asset class continues to be attractive. And the one thing that I think you guys have all probably heard about now, so infrastructure does involve building out of data centers. Data centers, if done correctly, if contracted correctly, can result in some pretty good, growing cash flows that have a lot of certainty around them for many years in the future. Based on just how they're structured. They're typically take or pay contracts. They typically last, 10 to 20 years, if not longer. And so those aspects make infrastructure, generally, a little bit more above average attractiveness. But then you also got to think about the traditional infrastructure asset classes, pipelines, roads, bridges, and tollways, airports. Those assets are likely, because there's so much attention and capital being directed to the data center world. Those areas are probably going to be a little bit light on capital deployment, which means that if there is some softening or some slowdown in the build out of data centers, those traditional infrastructure investments will be ready to go. There's probably a lot of shovel ready projects there as well. So just kind of keep that in mind when we look at portfolios. We expect to have a diversified approach. When real estate was struggling, private credit was doing really well. Private credit slows down, some of these other asset classes will come in and fill the gap, right? So that is the true meaning of diversification. We don't want all of our asset classes, we don't want all of our funds working exactly the same and outperforming at the same period of time. That would not be a diversified portfolio. So we always know that there's something working in the portfolio. We always know that there's an opportunities present ourselves, and we'll continue to be looking for those opportunities. Last, before we sign off, just wanted to kind of reiterate, we did make some updates to our tactical portfolios. Again, we do keep an eye on markets, even when things are getting volatile, even when people will have to travel out of the office, we're still keeping an eye on where the opportunities are. A couple weeks ago, made some adjustments. We actually reduced our overweight to value. So value, you guys remember at the start of the year, was showing some of the most significant discounts that we had seen in this investor's lifetime, but also had some catalysts, some tailwinds where we're starting to see, towards the end of 2025, some of the companies that are investing heavily and taking on debt in the build out of these data centers, the market was starting to reject that thesis, or at least reject that debt formation a little bit more. And so that kind of gave a little bit of a catalyst for value to start performing. So we added to our value overweight earlier this year. Value had done quite well in the first couple of months of the year. So we saw those spreads compress a little bit. And so we took a little bit of that value overweight off the table, and we actually added momentum back to the portfolio. You guys might recall we removed momentum sometime towards the end of 2025, mainly because the cost of those momentum stocks, the winners, were priced at such a premium that we said it's really hard to see that premium continue to build, and really just takes one crack in that story for that premium to be eroded. And so we did see that crack form. So now that momentum stocks have kind of come down to earth a little bit more, we think we thought it was a good time to get back into that style of investing. So you'll see those two things show up if you're a user of our model portfolios. That's about all we have for today, guys. Hope you enjoyed the conversation. Really interesting stuff to keep tuned into. We'll be back in a couple weeks to see what's going on with Iran. We'll talk about our portfolios again. If you guys have enjoyed this podcast, please hit that like button, share, subscribe, and if you want to find out more, just come visit us at avidianwealth.com. Stay diversified.